Welcome back to another episode of Getting Real with Claudia and Jose. And today we have a very special guest. It's Alain Levoie from Capital Home Lending, and we're going to be talking about mortgages. Alain, thank you so much for joining us today. We're really happy to have you here. So I think this is just going to be a conversation about what's happening in Canada, in Toronto, more exactly, in terms of the mortgage world, right? So we have some questions for you and just keep it casual. Tell us a little bit about yourself. How did you get into the mortgage world?
Sure. Yeah, it's well, I went to school in Toronto, originally from Ottawa, Montreal area. And so I came over here for school, and I was here for 4 or 5 years at school. And when I finished school, I wanted to go surfing in Australia at the time. I was 21 years old. I had a lot of ambition, and I never made it out to Australia for surfing, but I did get a job at a bank to make money to pay for my trip. But when I realized that, I really loved working for the bank and was making some really good money at the time and worked at the bank for about 4 or 5 years. And then I got transferred over to CIBC head office. At that point, I was very intrigued with lending, and that could be mortgages or lines of credit, visas, that kind of stuff. My path sort of led me to mortgages with CIBC head office. We did a lot of corporate relocations for companies like Labatt's and Molson and Department of National Defense. So got a real good sense of, what markets are doing in different areas of Canada. Fort McMurray being one. There's a lot of people moving to Fort McMurray back in the day with the oil push. But that was sort of like my introduction to mortgages. From there, I started an acquisition company with a developer in Toronto, and that was doing very well. And just by luck, I got introduced to some partners on the Remax side who said, why don't we do something, all of us together? Been with that company, CHL, for over coming on 15 years now. So it's been worldwide. So I've been in the industry for over 20 years, and it led from just working at a bank and doing some pricing and corporate relocation and starting up some different firms. So been in Toronto for over 20 years and in the mortgage business for over 20 years.
What did you find so interesting about lending? You've mentioned that you found it really interesting.
Yeah, no, I found that, lending can be, some people will shy away from it and say, we don't want to borrow money and it's expensive. But if you educate the client and the consumer in the right aspect with, this could help you fuel investments such as a house or things of that nature, then, taking on debt may not be as bad as you think it is, right?
Especially like when the rates were low, like you could be able to get a mortgage and use that capital or deploy that capital in like higher return investments.
100%. Yeah. Yeah. So a lot of times where even interest rates being low or high, we were able to show clients, you make this initial investment, provide a plan for 3 or 4 or 5 years down the road. Your first property is a condo. You put down X amount of money. The property appreciates. You pay down the mortgage. Now you have access to equity. You can pull out that equity to finance something else, right? So build a portfolio, so to speak.
But it's super interesting that you said, I've been in this market for 20 years as a mortgage broker. So you've seen a lot of changes in the market, right? Like you've seen when houses were still affordable in Toronto, and right now they're not as affordable. So how has all this changed during these 20 years in terms of the people that you're helping, the mortgage marketing as a whole? How have you seen those changes affect mortgages?
I think that a lot of it, you have to adapt, right? Real estate is very cyclical, right? So, there's going to be times where interest rates are a little bit higher, a little bit lower. There's going to be times where the property appreciates, doesn't appreciate. You got to set up the client for success with conversations and expectations, right? So, there's a time where rates are going to be very low, and then there's going to be a time where rates sort of go up, right? So you got to make sure that the client understands and can adapt to different markets, right? So that was my big learning thing, where you're not always going to have low rates, and you're not always going to have high appreciation. However, in my opinion, real estate's more of a long-term game than a short-term game. So real estate is a very good investment, but just keep in mind that it's going to be longer term, right?
Yeah, and I think one of the challenges with newer generations that are becoming homeowners is that they've lived through a cycle in which interest rates were low for so many years. And they believed that that was the norm. And now, like, coming into this crunch in which the rates are coming up, especially for people that are renewing probably next year in 2026, like having that impact on like mortgage rates doubling or like the expense being higher, like it's not something familiar to them. So that coaching that you mentioned is pretty important.
Yeah, and then the coaching is great from us, but the Bank of Canada does a great job on setting up Canadians for success, right? So
With
we
the
call
stress test,
the
or
stress test is what I was going to allude to. So yeah, the stress test was, when rates were 1.5%, 2%, the Bank of Canada said you need to qualify at 5.25%,
or
right? So
200 basis points above the rate that
way
you're.
above, so that if there was a fluctuation in rates, that you could still sustain the payment, right? So now what they've done, rates have come up. Um, the stress test is prime, or sorry, whatever the contract date is, +2, right? So there's still the stress test. It's not a fixed number. What it is now is more of a percentage. So I'll give you an example. Like if your rate's 5%, they qualify you at 7.
Yep.
Right. So that's sort of the
The way that they
threshold.
provide a cushion, like people
A
could be
cushion.
able to
Yeah.
handle that.
Now, that doesn't take away payment shock, right? Because when rates were 1.5, 2, 2.5, when people were booking mortgages years ago, and to your point, renewals coming up in the next year, they can still afford it, but
How is that going to
the
impact your
payment is
lifestyle?
now higher,
Yeah.
right? So you do have to curb your lifestyle a little bit. So on paper, you still qualify for the mortgage because we did our job making sure that you qualify for the mortgage. Now, that nice trip to Cabo or whatever, you might want to put that on hold now that your payments are $500-$600 more expensive, right? So it's not that you can't afford it, it's more of adjusting your lifestyles.
I totally agree with that because that was precisely my line of thought when we saw things happening. It's like, okay, we had this stress test, which in the end was a good call to have 4 years, 5 years ago, because people were being, how can you say, not studied, but like they were being, no, no, the fact that that you had a stress test helped people to understand, okay, even if the rate goes up to 5%, you can still afford to pay the mortgage. Is what are you going to do instead if you're already used to paying this money to another trip or other things in your life? Now you do have to adjust. Like that was my line of thinking, that because when people say next year you have renewals, people are not going to be able to deal with it. I don't know if I'm being naive, thinking that they actually will be able to. It's just that they have to adjust their lifestyle.
Absolutely, and then adjusting is one thing, but if someone is in a hard situation, and they've had a mortgage for 5-10 years, they bought at a certain price, they've reduced their amortization. There's certainly options for us to explore on, if whatever life throws at you, someone may have lost a job, who knows, right? But you do have the opportunity to re-amortize, during this renewal phase, right? So I took a 25-year, I got 20 years left. I can bump that back up to 25, just to provide that payment, less of a payment shock to these individuals, right? Yeah. So there are options, but back to our point, we were saying, the stress sets you up for success. That, yes, when rates do shift, if there is a movement, you are able to carry that mortgage.
And I think there's also an expectation that within a 4-year, 5-year window, which is like normally the time frame for somebody to take a mortgage, is that your employment can change and be like at a point. You could be able to shift jobs, and then basically you're making more money, and that sort of serves as a buffer.
Yeah. Well, during that time, like, life changes, right? So you've probably had a couple raises. You've maybe had some appreciation. You've paid down your mortgage, but now you may have started a family. You got daycare. You got that kind of stuff, right? So it's not one.
It's a moving.
Yeah. There's always every scenario is different, but there's always an option, is what I like to say, right? So although this situation may have happened, we can help you with this situation, right? So there's a lot of floating parts, and it's very different from person to person.
And going to that, like now they're saying 2025, 2026 is like the bulk of renewals is coming up renewals are coming up for new rates to kick in. Do you actually see that many people may not be able to handle the rates that they have, and it's going to flood the market with inventory? We don't think that's going to happen necessarily, because not all of them are timed coming at the market at the same time, even if they did come to market. So Do you feel that there's a real risk for that? I know you don't have a crystal ball, but
No, I don't. I think that the I don't know. To answer, short answer is no on that one. I don't think that we're gonna get a situation. So the process for renewals is when you get your renewal statement, you get a list of terms. If you've been paying your mortgage on a regular basis, you just sign, right? So you don't need to requalify. You don't need to get your property appraised again. It's just basically, can you afford these payments, right? So that being said, I don't foresee a lot of,
Risk.
default or anything like that. Like we're pretty good in Canada for
delinquency,
for delinquency.
the spike is significantly, I guess.
Well, the only time that it would perhaps be a little bit higher in one region or another is higher price points, such as a Toronto or Vancouver, right? So if there were to be more delinquencies, you probably see it on someone that's carrying a higher mortgage amount than someone that's carrying a lower mortgage amount.
What are the current rates that we're seeing in Canada for like fixed mortgages, variable mortgages?
That's a great question. It's it's typically, and this goes to fixed versus variable. I'll touch on that a little bit. It's traditionally, and I'm going to refer to 5-year terms. Traditionally, the 5-year fixed will be less attractive than the 5-year variable. We're in that weird pocket where the prime rate is higher than what 5-year fixed rates are. Now, that being said, prime rate is forecasted to come down over the next 16, 24 months. So it's sort of going to be the 5-year fixed and the 5-year variable are going to sort of meet somewhere in between at some point. But traditionally, if you look over the last 40 years, the 5-year variable would traditionally outperform a 5-year fix. So to answer your question, we're seeing right now a little bit more clients taking fixed rates, but traditionally shorter terms, in idea that Bank of Canada is going to come down, right? So that when they do renew in 2, 3, or 4 years, they're going to be a position where Bank of Canada come down, and that maybe they could look at a variable rate at that point.
So right now we're at what, 4%, 5%?
The spread's about 1%. Yeah.
Okay.
Yeah, between the two right now.
So there are many people who might not even know what the prime rate is. So what is the prime rate, Ella?
Great question. Prime rate is they also refer to it as a key lending rate. Key lending rate is a interest rate that the Bank of Canada sends out, and lenders will base their credit products, so lines of credit, mortgages, that sort of thing, on this key lending rate that the Bank of Canada sends out.
Okay, but not all the mortgages are based on the prime rate, or the mortgage rate is not based necessarily only on the prime rate. Can be based on something else.
It's either or. So you either take a fixed rate and what you're fixed, and the terms are generally 1 to 10 years. Most people land at 5 because it's just the median. But the variable rate fluctuates with the key lending rate. So this is why a lot of people might think that there's a risk involved with taking a variable rate. But if you understand a little bit more
what the trends of the market are,
we can show you a graph of what variable has done over the last 30, 40 years. And yes, of course, there's spikes and valleys or peaks and valleys. But if you look at the overall average on the graph, you're going to see that traditionally
it's a better option
you're a
than
little
the
bit
fixed.
lower than the 5-year fix, right? So, and a lot of people will have the idea that, or they'll want to lock in just for that payment. But it's our job to show them that if you lock in, yes, that's fine. But if you ride the peaks and valleys, this is where you're going to end up traditionally, right? So it's more of an education piece.
And the other question would be, if you were a consumer looking into home ownership and deciding whether you go fixed or you go variable, if it were you buying a property right now, what would be your strategy in between getting a fix for a year, 2 years, 3 years, shifting to a variable?
I'm going to go on the record and say I only take variable rate mortgages. So that's
You
me.
only do?
That's me. I've never taken a fix.
Okay.
And I've had lots of mortgages. So, but my reasoning is I'm okay with it. I'm in the industry. I see what the trends are. I know if I need to action something,
You're okay with the risk. If there is a risk.
The risk is, I love that word, risk. Like in my mind, there's not really a risk, but
Perception of risk.
it's a perceptual risk, 100%. But yeah, I would take variable. That would be my, here's the
thought process.
The thought process between a fixed is someone that's really tight on their budget. They can't handle, they got a minimum amount down.
They need that security. They need to know what the parameters are.
They need to know exactly what they're paying for the next 3, 4, 5 years. That point, you identify that as a mortgage broker and you say, okay, you know what? You may be better suited for something fixed.
Yeah.
Right. Just so that you can budget. Right.
But what about if you wanted to maximize the payments of interest and keep it as low as possible? Would you go 1 year fixed until the rates actually come down on the variable side and then shift to a variable product?
That's a good question, Jose, because we're not in a traditional market. So traditionally, the way the fixed rates are the lowest term is the lowest rate. So a 1 year will be 4%, a 2 year will be 4.2, so on and so forth, right up to 10 years.
Because there's risk. Like the
Yeah,
longer the
But
less you
we're
can
in a
forecast.
market or a segment right now in the market where the shorter term fixed rates are more expensive. So if you take a 2 or 3 year fixed rate, it's going to be more expensive than taking a 5, right? So that's the only caveat right now with fixed rates is, the shorter term stuff is a little bit more expensive.
Yeah, because the bank or the lender would see a better option if you went with a fixed, a longer term instead of waiting for that variable to
Because
come
most
down.
likely the rates are coming down and they don't want to
Yeah,
take
and
a loss on that.
Yeah, that's true.
No.
Yeah.
Don't get that. Okay, so we're gonna talk a little bit about for first-time buyers. Like many times, even in our profession, they're the ones who need more education. They need to know more information. They don't know where to start. They don't know how to do it, and it's not because they're not good at finding information. There's tons of information online. They just don't have the right guidance. So, if it was you, what should first-time home buyers need to know to get a mortgage for a property in Toronto? Like, what would be your 3 or 4 steps that they need to
Yeah, that's a
to
great
keep in
question.
mind?
I first and foremost, I would suggest that there's a literacy for financial in school. First and foremost, I'm just throwing that out there. But because people just come into working their first job, they get this money, they don't know what to do with it, they don't know how to save it, they don't know how to manage it, right? So that would be the first thing. But that's not your question. So
And we can't control the schools. They're not doing
control the
it.
schools. This is where parents need to come in and say, we need to do a little more finance 101 with you guys, right? So anyways,
Since they're younger.
they're younger, right? So pre-approvals are so important. It gives you an idea of budget. It gives you an idea of payment. It gives you an idea of, what you could afford, budget. But I think that, in the event that because someone might come to me and say, I'm looking to buy for X, right? And we might say, unfortunately, you don't qualify. So that's normally what they'll do. They'll come back and say, we don't qualify. So they don't know that, if you take these 3 or 4 steps, this is how you could qualify.
Like
Right.
improve your credit.
Well, it could be credit, it could be down payment, it could be employment, right? So, employment such as, it also depends on the property too, right? So the price points in Toronto are huge, right? So what we're seeing on our side with our team is people buying properties with investment or income coming in, right? So now whether that be a basement suite, laneway house, or if you're buying a property like a condo of 2 bedrooms, you live in one and you rent out the other one. Now, traditionally, lending doesn't recognize if you were buying a 2-bedroom condo, for example, and you rented out the extra space for whatever that amount may be. Lending doesn't traditionally look at that, but we can make a case for it based on the overall portfolio of the file, saying, listen, we have a lease agreement in place. The day this person moves in, they're going to be getting $800 for that second bedroom. So we can put that towards our application where it might push you over a certain threshold, right, in terms of price point. So there's these little tricks that you can adapt to sort of make housing in Toronto more affordable.
And what about having a cosigner, like the parents being cosigners? You
I'm
think that would
okay.
be a good idea?
I'm okay with that. And I'll tell you why. Is the question of cosigner is, the cosigner, we use their income, right? So let's just say borrower one makes a certain amount, they qualify for a certain amount. I bring in a cosigner, mom, dad usually. Mom, dad now bump up that price, but mom and dad are not the one paying the mortgage at the end of the day, right? So can I bump up your qualification 100%?
Can you manage the monthly payments?
But can you manage the monthly payment, right? Because, for me, it's so when we see help from family members, it's a few things. One is cosign guarantor. The other one is they'll help out with gifted funds, right? So for me, I would rather see gifted funds, so it brings down the mortgage amount, and they're a little bit easier on the mortgage payments, right? But yeah, we do see cosigners all the time, and you're seeing it more and more in today's market, especially in pockets like Toronto.
And I guess the gifted funds do have that impact as well, because if you're less than 20% down, then you're going to be
Insured.
high ratio mortgage. So then you have CMHC coming in, which are additional expenses that you could be potentially avoiding if you have like 20% down.
Correct. Yeah. And up until recently, insured mortgages, which is 20% or less, like you alluded to, the max amortization was 25 years. But now Bank of Canada said we can now increase that to 30 years.
Okay.
Yeah. So there is a bit of leeway now with insured mortgages. So
Perfect. So it's important that you mentioned the pre-approval, because when a buyer who wants to buy their first home comes to us, that's the first question we ask them, right? We're like, have you been pre-approved for a mortgage? If you're going to finance, most likely they will, because prices don't allow you to pay cash. And what we found sometimes with some of these first-time home buyers is that they don't know exactly where they are in terms of how they will obtain the mortgage, because they don't know their credit, or they don't know how a student loan or another loan that they have, or a credit card that they mismanaged, or a car lease is affecting their affordability. So have you seen those challenges? Like, what are the main challenges that you have found these people, like the first-time home buyers, are facing when they come to you to ask for a mortgage? What do they have to fix before they can?
well, that's the challenge, is they don't know, right? They just assume, I only make this, I only have this, that kind of stuff. They just assume, right? So when they come to us, like I said before, is if perhaps they might not qualify now, but we sort of give them a few tools on how, if we set you up 6 months from now, you might be able to afford this, right? And then we'll do a spot check on them and say, have you been doing these little tricks? Like, one is credit, right? So someone comes in and they're first-time home buyers are young. I've only ever had a $500 credit card for, student stuff when I was, going through school. Well, unfortunately, lenders want to see 2 trades active for a minimum of 2 years. Right. So this is where I'll say, take out another credit card, put on a small balance, pay your payments every month. That will build up your credit so that when they come back, and we don't have to wait 2 years, we can wait 6 months, a year, so that when you do come back, you now have driven up your credit score. You have 2 trades active. The lender will identify that, and then we can qualify you. Right. So although people are coming in and saying, we might not qualify, we sort of provide, or we try to provide, a few different tools on, let's set you up for, down the road.
And paying down student loans, I think, is also one that I usually see, like we usually see with first-time buyers, that they're carrying a student loan, and that to some degree handicaps their ability to approve for a higher amount.
Student loans are not usually the hiccup on this one. It's because those are interest-only payments, and usually they're very small payments. And with a statement from whatever company holds the student loan, we can say this payment is only this, right? So it's more consumer debt, like credit cards, lines of credit, car leases. I don't find a lot of first-time home buyers have big car leases, but yeah, like we could certainly, if they did have a car lease, we can say, sell your car, sell your car, or find another, take the bus.
Pay out the loan, yeah.
Take the bus. You want the house or the bus? Which one you want, right? So
What is the most common term that you're seeing first-time home buyers are applying for? Like 20 years, 30 years, 15 years?
What, amortization?
Yeah.
what are they amortization for? It's always the max, right? So always the max, because the shorter the amortization, the less you can qualify for, right? So we're always seeing clients in the 25-30 range at least. Yeah.
It's more because of what you mentioned, or they also want to manage their cash flow better, or
The higher the amortization, the lower your payment, right? So from a qualification standpoint, it makes sense for us to make that amortization as high as possible so that you can qualify for this. And then once you get in the house and you get into a flow, most lenders will have a payment increase option, so that if your payments are comfortable, you can increase your payments by 15, 20%. And it has the same effect as taking lower amortization. So for us, is we always set it up for the long amortizations, so that, for a rainy day, if the payments are, if your payments are more attainable, then you could look at increasing it down the road, right? Depending on what your job situation is, or whatever the case may be.
And another question that people have is between let's say, for example, a mortgage specialist at a bank, or a staff member of a bank, and a mortgage broker. What should they expect? Like, what is the advantage of working with a mortgage broker? Is it for self-employed? Is it for like anybody like that has like a stable job? Like, what would be the advantage?
Well, so there's this famous saying, you go to an ice cream store, you go to a bank, you just have vanilla, right? So for us, we have the whole
31 flavors.
The 31 flavors. We're the Baskin Robbins of mortgages. But no, but we have more options with different lenders, right? So for us, we have access to over 40 lenders. So if you don't fall under bucket A, you might fall under bucket B, bucket C. Like it's our job to identify that. So whether it be self-employed, someone who's salaried, someone who has commissions, we're really good at identifying, and all these different lenders have different programs, right? Like there are some lenders that do strictly equity, right? So you got a certain percent down, they feel that their risk is mitigated as long as by that down payment, right? So there's many different avenues, but again, to your question, it's the bank only has what they have in their arsenal, right?
Yeah.
Whereas and for us, it's we have access to the charter banks, monoline lenders, but we also have lenders that will do co-ops, and we have lenders that will do commercial and private and alternative lenders. So we do have lenders that someone may get declined from a bank that come to us, and whether it be, outstanding taxes or credit or whatever the case may be, we have them, they still get the mortgage. The rates are marginally higher, but we usually set up a strategy where let's just call it bruise credit. So we can say, you've missed a few payments, we're going to pay that visa out, whatever. And then in 2 years from now, when your credit score is back up, we can convert you back, right? So there's a lot of different angles that we can take in our space.
And then to make it more digestible, can you say that for the people who are listening or looking at this video, watching this video, what we've seen A lenders and B lenders. What is that?
It's okay. Good question. I'm gonna try and make that as less well. So what they refer to A lenders is like your grades. Like A is really, it's the top, right?
So
B,
typically like the big banks and
yeah, it would be someone like a Scotia or RBC or First National or CMLS. Like these are all chartered banks. Now the alternative lenders are also banks, but they're just they have different guidelines, right? So they're able to, if you're self-employed, you don't declare a lot, they're able to extend their ratios, for example, knowing they'll look at your gross, your financials, and say this company generates X amount of dollars. Their take home personally is not as significant as what they would want, but they do identify that the business does make money. The business is what's fueling their day to day, and they understand that that there's certain expenses. So it's an alternative channel to and this is where if someone does take something like a B lender, we can then look at making them on the A side.
because sometimes people may think that B lenders are bad, like it's bad, like you can't. That's a misconception.
Big misconception.
What would be the advantage
Well,
of using a B lender?
B lender will get your foot in the door, right? And
especially if there's a trend that the market, the home prices are going to be increasing, then basically you get in before the increases take place.
Absolutely. And to be fair, like the difference between the two is not huge. Like we're not talking 5 and 10%, right? We're talking like 5 and 6, right? So it's like the difference between something that we consider B or alternative is not as substantial as people may think.
And another question now that before you were talking about regulation, like what's the difference between lenders that would be from the bank or private lenders and credit unions? Because of the regulation, probably the guidelines are different for credit unions and gives a bit more flexibility in regards to like the way that the files are approved. Can you share a bit of insight?
Yeah. Banks are governed. They're governed through Canada, right? So credit unions are governed provincially versus federally. Federally is the word I was looking for. So credit unions are governed provincially, so they're different guidelines. So instead of the stress test that we talked to, prime or contract plus 2, they allow you to get approved on strictly contract, right? So you wipe away that 2%, right? So that 2% could be 15, 20, 25% on your buying power, right? Keep in mind that this is only for fixed rates. So there cannot be a fluctuation with prime. You also need 20% down. So we can't offer this product through insured because insured is all governed federally, right? So it's a great question because a lot of people don't know that if you went to a credit union, which we have access to, you could qualify at a contract rate, which, might get you over that tipping point of, whether that be 600 where you need 625 sort of thing, right?
But the caveat would be that you need 20% down.
You would need 20% down. Yeah.
Perfect. And then talking a little bit more about first-time home buyers too, like we see many of the first-time home buyers will opt for insurance, mortgage insurance, right? They will go less than 20% down, and that's changed as well recently. But is there an advantage really for them to take mortgage insurance?
The advantage is you get a marginally lower rate on insured business. The reason being is when the mortgage is insured, there's a insurance company that will, so in the event of a default, like if you stop paying your mortgage, it's insured. So the insurance company guarantees that mortgage, right? So they do price them a little bit better, 5, 10, 15 basis points on something that is insured. Now you do pay an insurance premium for that gets added to the mortgage. So, it all depends on your current situation, right? So if someone has rate at 20% and that is all their money, I would recommend scaling it back a little bit, taking the insurance premium, putting that money away for a rainy day sort of thing, right? So, but yeah, to your question, you do get marginally better rates on insured business because the risk is now taken away from the lender. But there's a premium.
So once you take that mortgage insurance, can you pay it off before the term of the mortgage is due, or you have to wait until your
It
mortgage
gets added to the mortgage. So it's not something you don't need to cut a check, right?
It's only for the HST. I think the HST portion has to be paid up front.
Correct. Well, it's 8% on the premium.
Yeah.
Right. So yeah. But the premium gets added to the mortgage amount. So you're not technically out of pocket. You need to pay it, right? But it's included in the mortgage.
So once it's included, you have to still pay it regardless. And then when you renew your mortgage, you can, of course, decide to put more money into your mortgage so you don't have to take insurance again. Is that how it works, or how does that work?
So I'm trying to answer that question.
Visualize how to explain. Yeah.
No,
Cam
but
is gonna edit it.
Yeah. But like it's when you're renewing your mortgage, you're not like you've already put a certain amount down, so it's not there is no premium, right? In short, right? But because you've taken that premium before and it's included in your mortgage, at renewal you will get the preferred rates as well, right? So you'll get that 5, 10, 15 basis points because originally you did pay that premium.
Perfect. So I guess it depends on the situation of every person, whether they decide to take the insurance or not. It will make more sense for
the
some.
down payment is the one that dictates if you take it or not. Like if you have the 20%, you avoid it. If you have less than 20%, you have to
It used to be
resubmit
a question of as soon as you got to 20%, you could take a 30-year amortization, which is the length of the overall mortgage.
And it doesn't need the CMHC approval.
No. And at 20% or less, technically it used to be 25 years, but now as of December 15th, you can take an insured mortgage and take 30 years.
What's the mortgage landscape like for real estate investors today?
Yeah, it's we're seeing that you need to have a little bit more down now. So, it traditionally with investment properties, you need 20%. What's happened in Toronto is prices have gone up more than rents have caught up.
Yes.
Right. So investors need to put down, what I'm seeing is more down payment, right? So we're, instead of 20, it might be 30, 35, just to make sure the property cash flows, right? You don't technically have to, like you still put 20% down, but you might be out a couple $100.
Does it vary by lender? Because I see some lenders, if it's an investment property and you're not planning on living there, they probably would require 35%. Is that widespread or is that?
No, that doesn't.
That's specific.
That doesn't exist. No,
Okay.
but we do have lenders that will, because traditionally the way the banking works is we will take 100% of liabilities. So PIT, principal, interest, taxes, condo fees if they exist. And then we can only take 50% of the rental income, right? So the idea with this is that as you grow your portfolio, it becomes more and more harder to qualify for these mortgages because you're taking 50% of the income, but 100% of liabilities, right? So the only thing that I would say is when you get to like an investment where you have 2 or 3 properties, you may want to move it into a holding company. At that point, you're pulling it out of your personal name.
Yeah, and it doesn't affect your credit.
It doesn't affect your credit. So now this holding company holds your real estate, not you, right? So you do provide the personal guarantee, of course, but it's not part of you and on your credit and all that stuff.
Yeah,
right?
and it's not the liability. Somebody
It's
like
not a liability. Yeah.
has a claim or has anything, it doesn't affect you directly.
So that's what I'm seeing with investors. A little bit more down, and a little bit more down is fine. And what I'm seeing is a lot of people coming together. Like if there's 2 or 3 investors that are looking to buy real estate, they'll come and pool their money together and pick up maybe 5, 6 units or whatever, right? So that it's not coming out of their personal property or pocket as much, and they're sharing the cost with other investors, right?
And risk.
And the risk, yeah. And this is where you can do a holding company in all those investors, or you can do the holding company in your investment. The holding company for you that holds the investment in the big holding company, right? So there's different angles. It gets a little complicated, but there's certainly options out there for investors to build their portfolio and make it, it's not as hard to qualify.
And also, especially like with investors, I think there's a threshold that if you reach it, you become commercial instead of residential. Like if you have more than 5 or 6 properties, you no longer qualify for residential.
Are you talking about the real estate specific?
No, like investors. Like if you hold several properties and you get to a point that you have 5 or 6, can you continue to get like residential rates, or does it shift to a commercial?
No, you can still get residential.
Okay.
I think it's when it's the amount of doors, right? Like, so 1 to 4 is considered residential. Anything above that's considered multi-res.
Okay.
Right.
What would be the best advice that you can give to a person looking to obtain a mortgage to buy a property in Toronto?
Well, that's a loaded question. Best advice?
Yes.
I can't just give one.
Okay,
But
2 or 3 then.
yeah, no, I think that for the advice that I would give is that there's never a perfect time, right?
Don't time the market.
Don't time the market, and don't, some people might say, oh, chatted about earlier is, we can't afford it, or, we don't have, they don't know, right? So there's never a perfect time to jump in the market. You just have to do it, right? But I think that if you're able to consult with a professional who knows what they're talking about and have experience in the industry and line you up with the most amount of information, so that when you do jump in, you have that comfort, exactly what you're getting into, exactly what your expectations might be in the future. That would be my advice. Like, so there's not really a perfect time. Just, get your ducks in a row, talk to someone, and then take the plunge. The pool's cold. It's going to be cold. Just do it. Right? Once you're inside, you get used to the water, right?
Especially if plan of
yeah.
your financial build or wealth building includes real estate, right? Because some people might prefer to rent for a long time and then just use that money to put it in another type of investment and not buy at all. But have you seen many of this type of people coming to you saying, well, we might just like rent, not buy because we feel we can't afford?
I have clients that rent and have a real estate portfolio, but they don't own their own home, right? So they don't want to invest in their own home, but they'll invest in other stuff, right? Because if their mindset is the rental, they'll rent something small, but all these pieces of real estate that they own is generating income, right? So they want to minimize their costs on what they personally have to grow their portfolio on, something that
Investment properties.
Yeah, that creates income.
Like if you had to put together a basic list of documents that people need to have at hand to apply for a mortgage, which documents would those be?
Well, again, so it depends on the client, and some people don't even know, right? So like, I'm self-employed. Someone would be like, well, I can't get a letter of employment or a pay stub, right? So this is why we would say, like, have a consultation with us. But like, short answers, income, right? So whatever that looks like, proof of income.
Or las NOAs.
Yeah. Or down payment, like statements, right? To show that you have the money set aside.
To show where your money is to put
Yeah.
the down payment for
Yeah.
the purchase.
So those are the income and down payment are the 2 big pieces. If you needed to put something together, I'd recommend that.
Then the credit, you're going to pull it.
Credit's us,
directly,
the ratio's
right?
us, the guidance and, get you to where you need to be is us, right? But for all intents and purposes, if you want to provide something, income and down payment would be what I would suggest.
And for the funds, be it gifted or their own, they have to be 90 days in a financial institution.
Only
have
if
the
they're
history?
coming from an institution outside of Canada.
Okay.
Yeah.
If they're local, they don't have to the 90 days
No.
provision. Okay.
Are there any tools that you would recommend for people to look into before getting a mortgage or for learning about mortgages or?
Yeah, there's lots. We have an app. So if you want to, you have to reach out to me. I have to flip it to you. There's not, it's Canadian Mortgage Trends. So we have an app on the application, on the app, you can see like a high level, what your budget is. It'll give you an idea of payment. It'll give you an idea of what land transfer tax would cost in Toronto. So we didn't touch on that, but you do get a land transfer credit as a first-time home buyer. So that certainly helps. And it has rates, different scenarios. So the app is very user-friendly. I would probably suggest something like that just to get a sense of
Started.
what rates are doing, what would it cost me, what are the lenders available, that sort of thing.
And Alain, I guess you had a lot of like good stories and horror stories. Can you tell us one good one horror
I'm not
one?
gonna maybe not the horror stories, but there's certainly some out there.
But there's something to learn from those horror stories too,
Yeah,
right?
yeah. Well, I do. You asked me that question on the way here, and I there was one that I thought I was particularly happy with was a lady out in Oakville, and she recently lost her husband, and she had 3 kids, and she was selling her matrimonial home, which is very expensive, and downgrading because she was down to one income. Um, Now, traditional lending states we need to prove all the income that's coming in, right? So we knew that she had a certain salary, but I knew that she had a settlement coming in from the insurance company because of the passing of her husband, right? Now, you can't use that, right? Like we're getting a certain amount of money, right? Like the bank can't say we're getting this amount of money. We know that she can afford it, but I did find a lender that was able to make the exception, right? So in her mind, she was like, well, how am I going to afford this, right? So, but we knew that there was a certain amount of money coming in. So long story short, she was able to get the mortgage with the assumption of this coming in, right? So traditionally, we don't
You're not
approve.
able to do that.
We're not. We can't approve assumptions or future income or whatever. But with this particular case, loan to value, her credit, the conversation, providing the story to the lender, we were able to get the exception. So I was really thrilled about that. Like that phone call for me, calling her and saying, "Guess what? You got your price."
Yeah,
It was
those are the
awesome.
best
It
phone
was
calls.
awesome, and I could hear the kids in the background, and she had gone through some tough stuff. So, but that was good. It was a good
That's a
story.
good win.
Yeah, totally.
Good. So how can people communicate with you, get in touch with you?
They can go to the website capitalhomeLending.ca, and or they can reach me at 416-419-0359.
We can include Alan's information in our video as well. So
Yes. So thank you so much. This has been so informative, and we're really happy that you were able to join us.
with that being said, don't forget to share, like, and subscribe, and we'll see you in the next episode. See you later.